So over the past few years, I've done prediction videos here and there, gone into multiple different scenarios and explored different data points essentially for how I establish these different scenarios and how I more or less to predict some things in the markets. Now, some things has gone much better in predicting than other things, and so we're gonna actually go into last year's predictions and more or less look at what happened a year now later or 8 months later or something like that. Since I think it's pretty good to update y'all on more or less my future projections of the markets and go into detail, show you guys the data for essentially the thing I'm looking for going into far-fetched future, but also short-term, intermediate term, etc., etc., and more or less go through like an 2026 predictions. But I'm nevertheless gonna have a heavy focus on data. All right, so I'm gonna more or less show you guys the data so you can make your own decision based on the thing that made me overall get the sort of prediction scenarios I have gotten. But before we explore anything further, we'll just look into last year's predictions and then we'll dive into the new year's predictions.
Bearish buys. But you will also notice that just looking at just pre and historic data, we are extremely high for the DXY. So I would suggest, as we have seen previously bearish order flow here, that we should continue the bearish order flow here, as now we're structural confluences for bearish prices. Does not give us and signal bearish prices, but just gives us the structural confluences. Now, what signals bearish prices is the way of just, you can also see the higher time frame market making model here as well. So now just quickly looking at EURUSD on the lower time frames, we are now on the 5-minute charts for EURUSD. What everybody can see is pretty much that we have been in this consolidation range and that we have just swept. This is the sell side liquidity annotated. Now we have the potential of having a large expansionary day on Monday, in which case I think that would be a manipulation case, meaning we're going to probably reach down lower, potentially reaching for this level. Now afterwards, we have the potential of seeing pretty much Tuesday pricing in a given low and potential PPI being bullish, and then CPI being bullish, and us just continuing higher with a very bullish week. This is what I potentially think is the very likely outcome of this entire week. I'm seeing very bullish, but just note, stick to your own.
So keeping it true to the word, essentially we're gonna now go into some of the predictions I made like 2025 or 8 months ago. I'll link the YouTube video right here in the call, so everybody can just go in and click in on it and watch it to see if the things is in order. So I'm not doing all of this, showing you all of this, and it's not really there. It's not really what I predicted. It's not really the levels I had. But nevertheless, we're gonna go straight onto it. I'll cover some of the things I previously said, and those things were overall, as you heard, the levels we were watching an 109.642 level for essentially the dollar. Might have been 640 as well, so might have been like 109.640, something to that extent, but at least very, very close towards this, in like a pip of a difference or something like that. And you can see that actually ended up being the high of the dollar approximately 8 months ago. I also made a video 12th of January, and you can see this high was more or less established 13th of January to where the actual low was and ended up being. Now all of this might sound crazy now, but of course back then it was just based on probabilities and based on where I actually got these extreme low, extreme high levels, based on where the fundamental equilibrium was located. You can also hear me talking in that call that I was looking for CPI and PPI going up higher, essentially rising, so inflation rising. And when inflation rises, usually you see interest rate anticipations go up as well, which overall therefore leads to a lower supply of the currency because of quantitative tightening, but also higher demand for the currency because of uncertainty. And actually you can also see that this was essentially the low and the bottom to more or less amplify what I showed you and actually what ended up happening. And so you can see right here on the left side corner what I actually anticipated. So let's just go into that video and hear what I anticipated happening day to day. And so you can see we actually ended up predicting the bottom, but this might have seemed crazy now, but it all was just based on probabilities. And as you can see, this actually ended up being the low of EURUSD. So if we just zoom out to the 1 hour, you're gonna see that more or less you have the low here, the 1825, and if you just go up, you can see essentially that's the low of EURUSD. Pretty crazy, but it's all just probabilities. Now in that video, I also ended up discussing what I was looking for happening to indices, but also crypto, and my conclusion actually ended up being that indices and crypto would see a massive high that I was looking for, more or less Bitcoin to reach new all-time highs, and that I was looking for NASDAQ, etc., to just go and deliver up higher. And nevertheless, that's exactly the thing we have seen. So, all of that said, let's just go straight into 2026 price predictions, market predictions, financial market predictions. Now, a good starting point of essentially where we're at, looking at macro, is simply actually going into more or less a map showing you all the world. So we have gone from essentially having 0.25 to 0% federal to now in 2025 having massively high interest rates all across the world. As you can see, right, going from Europe to France, essentially the whole European Union, Americas. Now looking at just quickly the long-term cycle of interest rates, primarily you can see overall that the US has actually throughout its history not had 0% interest rates as we started having prior to the 2008 financial crisis. Now I believe this is a good starting point to just visualize that we usually don't have 0% interest rates, and the 0% interest rate just came about because the Fed needed to do quantitative easing. Essentially buy whole lots of bonds to artificially push down the yield prices of the long-term yields, which is another thing we're going to look at later. Now this is good to explain simply because this means that there have been a lot of artificial money in circulation all throughout the world, but primarily the US, which is our primary focus. Since the US covers 80% of capital markets and it's primarily the currency I'm focusing on. Now this is just a visualization of the money circulation or M2 money supply, and as you can see, ever since they artificially pushed down the yields artificially by buying bonds, artificially boosting demand for the bonds, therefore driving down the yields in the process, since essentially the yields is just overall how much investors want in return from essentially holding a long-term maturity bond. Now when the yields and also the federal funds rate is low, you have a higher probability of seeing government, the US government, and of course because all the rest of the interest rates in the world correlated starting 2008, we more or less saw whole world's money supply go haywire, with governments starting to print massively and going into massive deficits starting 2008 to support their economy during the 2008 financial crisis, and moving on further. Perfectly into our point, something you'll need to monitor in the future, in the long-term future, is the ever-changing bond investors. If we are to survive this massive deficits, for the governments to solve these massive deficits, the Fed cannot be the ones holding the bonds. And in fact, the Federal Reserve is not planning on stopping its quantitative tightening anytime soon. Instead, it's planning to keep going with its quantitative tightening. And I see this as a possible crisis coming up in the future, because if the governments cannot manage its deficit spending, since we're gonna see yields not being artificially pushed down this time, potentially, when we're seeing the lower interest rates, we're gonna see that the bonds, essentially, the governments need to sell, be ever so hard to sell, meaning we're gonna automatically be forced and have a forcing function to have a high yield now, even if we go down to an 0% federal funds rate. And nevertheless, I don't even think we're gonna go potentially all the way down to 0% interest rates. Potentially, if we go into deflation, but I'm not seeing deflation coming out anytime soon. But this is just something to monitor for the long run. But I'm mentioning this nevertheless because this potentially could be a scare coming 2026. Now the interest rate will also play a very important part going into 2026, since essentially I've gotten a lot of hints from the Federal Reserve about what's going to happen to the federal funds rate. Now, already said that I don't think they're going to start with any quantitative easing and stop with their quantitative tightening anytime soon. But what am I looking for the interest rates being a year from now? So personally, I think coming 2026, we will start 2026 off with a neutral rate. We've already gotten indications of essentially why they want it to be at a neutral rate starting 2026, a neutral rate being an interest rate where it does not lead to an expansion automatically and or any tightening automatically. Whilst right now, this interest rate at 4.25, even though we have started our cutting cycle by the Federal Reserve, is still. So I'll just pretty much show you guys some other things Scott Bessent, the Treasury Secretary, has said, and where he wants the level of interest to be at the end of 2026 and going further. And why I'm specifically going to show you guys this video is because a lot of people are thinking like Trump is going to influence the Fed into pushing down interest rates. And like I said, he is not going to do that. And I've said that multiple different times. There is no logic in that. He knows the implications of essentially infiltrating the Federal Reserve and their essential independence of the main governments. Because if he would do that, that would be another sort of massive scare for the markets. And I think that would be more or less a bleed for the entire markets. Infiltrating the Fed and making it less independent than it is currently will have massive implications. And that's not something I'm looking for happening going into 2026. Rather, I think the interest by itself will go down. I think currently we are at a too high of a level, and that pretty much also the other Fed board members think, and their overall assumptions is that we're going to be a neutral by the end of 2026, meaning that we're going to have 2 more rate cuts, and that from 2026 there will be more leaning towards data, and I think that data will need the Fed to cut even further, potentially down to as much as 3% to 2%. Now I'm not going to go in detail and show you guys what the neutral level is. Instead I'm going to let you guys do their own research about it. But like I said, majority of this will overall depend on essentially the news that the Fed gets starting 2026, and I think it's going to be more dovish leaning Fed going into 2026, just because we're going to have some new board members not directly influenced by the White House, but implemented by the White House, which essentially is going to drive the right monetary policy, because I think they're going to be accountable and I think they're going to do the right things. And primarily my analysis long term focuses primarily on these interest rates. My analysis is lined on essentially different scenarios we can derive from what is going to happen to the economy when the Fed's starting to cut currently and going through 2026.
I want to ask you about the Fed, because the president, you were standing next to him in the Oval Office, said he might basically make you one of the most powerful men in the world because he's considering you to become the next chairman of the Federal Reserve. Our CBS polling we just did shows that 70% of Americans want the Federal Reserve to make decisions independently from President Trump, but there's a big partisan difference here. 59% of Republicans say the Fed should be guided by what Trump wants. 41% should be independent of Trump. Which Republican camp do you fall into?
Oh, if I were in that survey, then I would say 100% that monetary policy, Federal Reserve monetary policy, needs to be fully independent of political influence,
Including from President Trump.
including from President Trump.
And something which a lot of people might not know is that usually after rate cuts, or nearly 90% to 95% of the time, we actually see a recession preceding rate cuts. So after a rate cut cycle have started. And yet again, you can see that back in 2008, back here, as everybody can see, Fed started cutting rates down to neutral, and you can see that was followed by a recession, prompting the Fed to quickly cut to a 0% interest rate in 2008. Now, this is the same thing going into 2019. You can see the Fed started its rate cuts, and essentially we saw it promptly go down to zero after recession was followed. Now, like I've said, overall this time will also be influenced on data and influenced by the short-term debt cycle, more or less business cycles. And it will overall, the Fed will pay major attention to what is coming the next few years overall. Are we going to see a recession, aka a hard landing, or are we actually going to see a soft landing, meaning the Fed is going to be with the curve? Now starting, I'm actually going to go through more or less my probability scenario matrix for if the Fed and if we're going to get a hard landing, meaning the Fed is going to be behind the curve. And one of the major indicators more or less for that we will, have a recession is actually the inverse yield curve, which is predicting nearly an 28.95% chance, which is essentially the same probability we got prior to seeing the recession back in November 2019. And you can see we have gotten probabilities up to 54% back overall in January of 2023. We have actually seen the biggest inverse of the yield curves since ever, more or less. And I think this will overall cause major scares coming through 2026. Now, the probabilities, as I showed you, is minor, like 30% chance of a recession happening. And I think they're quite good odds overall. Now, like I said, we've seen odds of upwards of 30% of seeing a recession. Now, even though they are very, very high, you can see we have actually seen the biggest inverse of the yield curves in history. And if you go deeper into the sort of underlying dynamics into meaning the why, you will promptly discover that we actually have been in a recession, just not a technical one for the US. If you actually look at the business cycle optimism index, you will notice that we have actually been at a lowest level of optimism levels in history, meaning we're nearly at a sector 4 of a stage 4 business cycle, which simply means that we might as well have been in a recession, just not only noticeable for ordinary people, meaning we have seen wages going lower, we have seen high inflation, we have seen layoffs coming slowly but surely, also seen by the buoyancy curve. But the only thing that has kept the US primarily afloat is the AI cap expenditure. And more or less, when you have understood that, you'll notice that, well, potentially, since therefore we have been in a rolling recession, we might as well be at the end stages of a recession. And so I don't think 2026 coming through the corner, we're gonna have any recessions. Instead, I think we're gonna have growth scares. And this is another thing in its total form. That is just because that also leans into the first thing we covered, that being essentially the debt burden by the US but also by other countries. If we see the, for example, global GDP decline or scares of global GDP possibly declining, we might see overall yields of those, debt burden countries go up, and that includes the US. And that's going to put a major strain on indices, both indirectly and directly by the growth scare, but also the yields themselves. And I think this is the most likely outcome coming 2026. Not that we're going to be in a recession, rather that we're going to see essentially growth scare coming through. And all of this brings us to a conclusion of the macros I'm following 2026. That being overall, Interest rates going more towards neutral. We're currently at 4.25 as y'all are seeing right here. And therefore, in conjunction, I think since we have had these major high interest rates and growth scares coming, I think inflation will therefore subside and they're going to go closer towards targets. And you can see the trend line is more or less pointing down. And I think we were even going to go into potential deflation coming 2027 or 2028. Now, as you can see, last time we had low interest rates, the USD and the USD strength was down below here. Meaning, essentially, we are looking at the dollar being extremely bearish until our long-term neutral trajectory of the dollar strength is hit. Meaning, in accordance to my predictions, I believe 2026 and coming 2025, I'm going to stay pretty bearish on the dollar. I'm pretty optimistic of seeing a lower strength dollar. That's also because the US is currently having policies directly influencing the dollar to go down lower as well.
So when we have a strong dollar, one thing happens. It sounds good. But you don't do any tourism. You can't sell tractors. You can't sell trucks. You can't sell anything. It is good for inflation. That's about it. Now, it doesn't sound good, but you make a hell of a lot more money with a weaker dollar. Not a weak dollar, but a weaker dollar.
Is, make no mistake, the U.S. still has a strong dollar policy, but that does not mean that bilaterally other countries can weaken their currencies versus the dollar.
And so this ultimately brings us to the intermediate time frames and ultimately my predictions, overall reaching 2026 and going into 2026. So as everybody knows now, essentially I'm looking for the rates to go to a neutral level. I've talked about what essentially that means, the definition behind the neutral level, etc, etc. So what am I actually looking for currencies to do on an intermediate time frame and on sort of lower time frame going into, last 2 months before 2026. Now, since I'm looking for rates going to a neutral level, meaning first underlying dynamic being extremely bearish for the dollar, that does not necessarily mean we're going to actually be bearish for the dollar. Instead, we actually could go against that because the short-term dynamics of the dollar is pretty free to trade wherever you want. Meaning it could go up, it could go down, etc, etc. But I think in accordance to I read technicals, because as you all know, I established technical analysis dependent on fundamentals, essentially. I'm gonna keep being very, very bearish for the dollar, while ultimately looking at us going into a momentum regime towards the upside. So short term, we might go for liquidity, while overall after sweeping sort of massive liquidity level, we're going to go down lower. Hence, this is something I'll be looking for. And us ultimately going down towards a neutral dollar level for 2026, as I previously said. Now, this will probably be reflected on sort of an inverse level on the exchange rate euro against USD, meaning that we might go into an extreme low level short term and then continue with a long-term trend since the dollar is pretty bearish. And actually moving out towards a monthly time frame, you can see that this level of euro is actually not that high. We were throughout the period between 2003 to 2013 trading in this sort of consolidated range in accordance to this neutral rate level, and also with the yields being very, very unattractive for US, while being attractive for essentially the euro area during this period, which is exactly the thing we're doing with this essential influence of the Fed cutting rates, manipulating the dollar lower, and therefore driving up foreign currencies, because essentially they're engineering both the supply of essential amounts of dollars in circulation, but also essentially manipulating down the demand of dollar, because they're changing the investor base of the yields. If you think about it, they're changing the investor base. They're going from central banker QE, from the central banker selling their bonds to investors, and then going to QT, essentially much heavier yields going into the future, and essentially much less demand for dollar, because there's going to be much less artificial demand for dollars, and of course indirectly therefore causing higher currencies. higher foreign currencies. Now, before moving on, I just wanted to show you some clips of essential Federal Reserve members talking about what they're going to do in terms of continuing their QT cycle and essentially their future in terms of, as I previously said, them going towards a neutral rate. And I'm going to go through some of the Fed members actually saying they're going to go towards a neutral rate.
Weakening in the labor market have increased. Proper risk management means the FOMC should be cutting the policy rate right now.
I'm going to feel comfortable that we're still on the golden path and things be okay for rates to come down. We put in a note of unease, I'd say, in the last CPI and now PPI.
Net effect of those. And so that's why it's important to take in the information and not lower rates preemptively, because we just don't have that certainty, and the economy's in a good place. At the same time, you can't wait forever, because if we wait till inflation gets to 2%, well, then we've lost. We've likely injured the economy in some way that was completely unnecessary. And so I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
And this is just the main reason for why I'm looking for higher foreign currencies, essentially. And that's just because you're looking at a lot of powerful people wanting essentially the dollar being weaker, and it's actually a good thing. The strength of the dollar essentially weakening is a good thing. That means lower uncertainty in the world, that essentially discounts, as I said, a lot of these other things, and that offsets interest rates, which, if we make a soft landing, will only overall result in massive gains for risk on assets. Similarly, you're looking at the rest of the world lagging behind the US, and therefore you see central banks such as the ECB and BOJ being at pause and being at essentially finishing and already at a neutral level. And since the market is at a forward looking pace, essentially, you're looking at more or less and strengthening foreign currencies to 2013 levels, while essentially seeing the dollar weaken, while other powerful people wanting these foreign currencies going up higher. And yes, economically, I think, yes, this will cause potentially a trade rebalance for other countries and for the US to start exporting more, and essentially potentially changing the trend you have seen in the export markets, where the US has been the world's major consumer, and the consumer sentiment might more or less shift towards Europe instead. And hopefully by 2028 or in the far future, we will also see China becoming a consumer-based economy rather than exporting-based economy with their major population. And so moving on and moving towards NASDAQ, more or less, why is my predictions going into indices, etc, etc. Like last year, I'm gonna stay and be completely bullish on indices. I think this AI revolution and essentially the pump it's causing into the markets, money more or less flowing into the markets, is just going to continue. That's it. And that said, I think, however, we might see some growth scares coming into 2026. And I think more specifically, we're going to see a more uncertain 2026, even though we're going to be bullish. And that's just for 2 main reasons. Number one, we're pretty much moving into the second year of the presidential cycles. It's more or less the year where you see less of this growth expandatory policy by essentially the presidents, and instead you see a little bit more not as bullish for markets policies coming through by the presidency, meaning it usually results in a little bit of an worse year in terms of returns. That said, I think overall it's ultimately going to end up being a very bullish year, I think, and I also predict that we will just see a continuing higher indice, especially now when we see bullish policies getting pushed around by the Fed, essentially lower rate cuts, etc, etc. That said, there's also going to be some worry about the Fed actually making a hard landing. As I previously shown, usually we might actually, the last times the Fed has actually cut we have actually seen us going through some kind of recession. Do I think this time is any different? Well, it might be, and that's why I'm monitoring the underlying situation, because yet again, I think we are currently in a recession and we are at the bottom of the business cycles. And I think essentially sentiment is only going to go up from here, which is the primary measurement of business cycles, and that we are just going to continue higher throughout the entire year. And preemptively, I think October, essentially throughout December, is going to also be very, very bullish. But starting 2026, I think we're going to be a little bit less bullish, but still bullish. So why is my overall targets? Well, I essentially think we're going to go up to 3,500. I think this is more or less a pretty good number, and I think this is quite easily going to get smashed. We will see, however, but yet again, this just proves that I'm bullish. Now going through something much more interesting, and this is actually crypto. What do I think of crypto? Why is my predictions, etc, etc. So as everybody can see, 2025 has been an extremely bullish year for crypto. We have essentially made, I think, upwards of 50% on Bitcoin and much higher on Ethereum, for example, even though it has been a little bit more choppy. Now, why is my predictions going into 2026? Well, I think 2026 is going to mark the end of this massive bull run. We have essentially, in this bull run, gone up approximately 600% on Bitcoin. It has been eccentric for Bitcoin. It has been extremely good for Bitcoin. Bitcoin has returned some massive gains. And as everybody now know, crypto cycles usually only last for 4 years, and then we usually see a 50% pullback, and I think this is going to be a true thing this year as well. So the last sort of months is usually the most bullish months, but then essentially we see a crash coming through on crypto, essentially something happening in its underlying markets which caused it to go down essentially massively. And as you all know, we're approaching sort of that 48-month mark where we usually see the highs. You can see this was essentially high to high 47 bars. And simultaneously, you can see essentially we're moving to that as well for this year. You can see 47th is approaching. It's essentially next month, this October. I do, however, think it's going to go on to early 2026. And then we're going to see downwards turn. And this goes for whole markets. What is my price target for Bitcoin? Well, I think we might go into, in these last final months, gonna reach 150k potentially if we see massive inflows in crypto. On a semi-intermediate time frame, you can see right here that essentially we have seen a dip coming through of essentially 5%. And as y'all can see, a lot of people now thinking, is this going to be the end of the cycle? Well, I don't think so. Instead, I think, like I said, we're going to see 150k Bitcoin coming through 2025 before we essentially see the end of this crypto cycle. And I think it's going to end early 2026. And it's going to end with a bang like you usually do. Now my targets for Ethereum in immediate term, I think everybody's wondering as well, is actually pretty high. I think they're actually going to outperform Bitcoin in the immediate term and short term. I think these last 2 months of the bull market, because I'm looking at 2026 being the early end of crypto cycle, is going to be the most eccentric and bullish you have ever seen. I don't know what's coming. Potentially it's the Clarity Act, potentially it's the rate cuts, potentially it's the retail traders finally coming into crypto and pumping up crypto. Potentially it's some other massively bullish news. However, I think after this dip, we are going to see it continuing pumping. This is simply going into net flows of more or less Bitcoin compared to Ethereum. Even though they have seen net outflows, if you actually go into the year, you can see that Ethereum has actually started outperforming inflows into its net accumulation. And so you can see total accumulation is essentially 2.3 billion or 23 billion, and we have 148 billion for Bitcoin. And you can see going into all of them, you can see that Ethereum is actually starting to outperform and weigh much bigger percentage role. And they have actually accumulated a similar amount of essential percentage of market cap on both of them. Now let's just finally go into the last part of this call, which is going to focus on specifically crypto. As you all know, we went through essentially my price prediction for Bitcoin. We're going to go over essentially it and why I think like more or less more data other than ETF inflows and sort of technicals. And as you all can see, overall we have a lot of treasury companies holding both Ethereum but also Bitcoin, and most notably Strategy. As you all can see, it's always increasing, it's holding in Bitcoin, and you can nearly call it more or less a cycle of essentially buying. Strategy is one of those essentially companies which holds a lot of Bitcoin. As you can see, they hold nearly 700,000 Bitcoin. Now, how they acquire that Bitcoin is through essentially first raising capital. Essentially, MicroStrategy issues new shares or forms of debt. Most of the time, essentially, it could be convertible bonds, essentially to raise cash. Okay, with that cash, essentially, they're buying Bitcoin. Okay, the cash essentially proceeds and are used to buy Bitcoin, boosting overall MicroStrategy's total holdings, and that essentially will lead to price appreciation in the stock. So essentially, then you will see MicroStrategy with the more or less Bitcoin it's buying. It will essentially go, and since it holds a lot more Bitcoin, that will also drive up the stock's price. And simultaneously, when seeing the stock surging, right? When seeing the MicroStrategy stock surging overall, that and even potentially outperforms Bitcoin itself because it trades at a premium to Bitcoin, meaning it trades at a multiple from Bitcoin. I think it trades at a 2x multiple from what Bitcoin actual price is. So it's nearly like leveraged. So if Bitcoin goes up 10%, MicroStrategy goes up 20%. Essentially, that's what it means. And that essentially, with the stock, when it surges, they can use that premium of the stock to buy even more Bitcoin with it, which essentially repeats the loop. Now, the problem multiple analysts, etc., including me, see with Strategy is that how can this realistically be sustainable? And the thing essentially for it to be sustainable, and the thing I'm watching, is for it to continue trading at a multiple from Bitcoin. You can see Strategy has essentially gone up much more on the chart, higher than Bitcoin itself. Just using this essential bull market, you can see last bull market it actually went up, but not as much. While this bull market has actually outperformed Bitcoin to, I think, and 100%. Like I said, 100% essentially has outperformed Bitcoin. So it's trading at a 2x multiple. Because as soon as it's not trading at a multiple to Bitcoin, it cannot buy new Bitcoin because it cannot issue any new shares. And because she has even done some sketchy bonds issuance, etc., they might even be forced to sell some other Bitcoin, which essentially I'm watching all about what's going on with these treasury holding companies, or crypto holding companies, I'm sorry. So overall, combining everything, even though I think crypto is going to be bullish going into 2026, from 2026 onwards, I'm watching if we get some growth scare coming through in the markets, will potentially put downwards pressure on the whole crypto space, which will especially also put downwards pressure on indices, in which Strategy is a big part of. It's essentially part of the S&P 500, and so ultimately we might see Strategy dip if overall some crazy thing happen, like if we see ultimately they need to sell Bitcoin, well, that would ultimately put a stop to the cycle. Other than that, I'm not seeing any other sort of problems, and that's why even if I'm bearish and looking for an end of crypto cycle, meaning looking at the end for this big expansion in the crypto market, I'm not looking at that much upwards pressures. I'm still therefore holding a target of 150k Bitcoin, but I'm going to be cautious going into 2026. And the same thing goes for indices, but on indices and on stocks especially, I'm a little bit more bullish. Anyways, hopefully you guys really appreciate this call. I put in a lot of effort into making this call. Hopefully you guys learned something, but especially look into the things I've talked about and the data I've shown you. So essentially crypto holding companies go into M2 money supply correlation to Bitcoin, and essentially go into looking at the currencies, the yield conversions, essentially from institutions to more normal people, essentially. So we won't go from yield holding from central banks essentially to other institutions and other sort of investors, essentially large speculators, etc. And all of this, and how this changes and going into 2026, but also how this goes together, okay, how they're interconnected, and how all of this research comes through. Because essentially I think 2026 is the year we're going to see most interesting stuff. And I think a lot of things will happen, a lot of good things, but also a lot of bad things, which will turn into opportunities 2026. Because ultimately I'm thinking we're going to be very, very bullish going into 2027, 2028 and onwards.